Hello friends, welcome to the month-end series of BFM. As you know by now, in month-end series we are covering all the subjects of CRR, compulsory ones, all of them. Numericals, objective questions, case studies, previous year questions, everything is covered. So follow the session completely. Follow the complete series, all the subjects. Click on the bell icon. Subscribe to the channel, click on the bell icon, okay? Don't miss this and like this video also. So let's start. See, today I'll be dealing with liquidity risk management. Liquidity risk management. Now this liquidity chapter comes two times. One is in module B also, last is in module D also. Two times you'll get this chapter. Okay? Not same, slight difference is there, but 60-70% it's same. Logically it's same. So follow the video till the end. Very important one. Huh? Roughly 7 to 8 marks. Yeah. What is liquidity risk in bank? What do you mean by liquidity risk in bank? The risk of bank's customers defaulting on their loans. The risk of bank being unable to meet its financial obligations when they become due. The risk of adverse movements in the interest rates. The risk of loss from internal fraud or failed processes. What is this liquidity risk? See, your focus should be on liquidity risk over here. So what is this liquidity risk then? It is liquidity risk is, see, I'll give you one by one. The risk of bank's customers defaulting, okay, on their loans. This is credit risk. This is credit risk. Credit, okay. Bank unable to meet the financial obligations when they become due. Liquidity, okay. Risk of adverse movements in the interest rate. This is called as interest rate risk, but actually it's market risk. Because all this interest rate risk, price risk, all these finally boil down to market risk. Risk of loss from internal fraud or processes, operations, ops. Okay, so the answer for this is liquidity risk is B. Okay, whenever you have to give the payment, you don't have money. Liquidity. Don't mix this liquidity with liquidation. Kindly understand that two are totally different. Liquidity crisis we always face, all the banks face. Liquidation is different. Liquidation means bankruptcy. You don't have money at all. It is liquidation. Okay? Why is maintaining adequate liquidity crucial for the banks? Crucial. Why is it important for the banks to maintain the liquidity? To increase the market share, to enhance the brand value, to avoid insolvency, to diversify the investments. Yeah, what do you think? Why is it necessary? Increase the market share. For market share, it's totally different. Market share has nothing to do with liquidity, isn't it? Means directly. Indirectly, it's there, but directly. To avoid insolvency, isn't it? Insolvency means moving towards bankruptcy. See, whenever you have liquidity crunch, huge liquidity crunch, then you will be having liquidation. Liquidation means bankruptcy. The other name to liquidation is bankruptcy. Okay. So whenever your liquidity risk becomes too huge, then it becomes liquidation risk. Okay. Next. Which ratio is commonly used to assess the bank's liquidity under Basel III? Which ratio is commonly used? Current ratio, quick ratio, LCR or debt to equity ratio? Under Basel III, see, typically it's mentioned under Basel III, you want it for Basel III only, nothing else. Basel III, liquidity. Some of you are typing this current ratio. Some of you are typing this quick ratio. Quick means liquidity ratio. Generally, all of them type this current ratio. The answer is this, LCR. There are two ratios in Basel III, very important ones. LCR and NSFR, very important ratios. What is LCR? We'll study in the next question. But what is NSFR? NSFR means net stable funding ratio. LCR is liquidity coverage ratio. LCR is for short term, short period. Short means 30 days. 30 days. And this NSFR is generally for 1 year. Generally, okay, 1 year. It is net stable funding ratio. Means whatever is my required stable funding upon whatever I am having as a stable funding. See, it is like this. Required stable funding. I'll write SF now. Required stable funding upon available stable funding. Okay, required stable funding upon available stable funding. This is the method of NSFR. LCR is what? Don't worry, I'll show you now. Next slide is for LCR only. Okay, LCR only, remember, it is for short term, 30 days. NSFR is for long term. So LCR now. The liquidity coverage ratio ensures that banks have sufficient quantity of. Now comes the formula of LCR. So LCR equals to HQLA upon cash withdrawal spellings are big here, for 30 days. Okay, cash withdrawal for 30 days. So what is HQLA now? Now that is, look at the options. The liquidity coverage ratio ensures that the banks have sufficient quantity of high quality liquid assets to cover net cash outflows over 30 days stress period. Low quality liquid assets to maximize the returns. Illiquid assets to support long-term investments. Non-performing assets to be written off. Answer already I gave you. Right? HQLA. For withdrawal of 30 days. Now two questions will arise in your mind. Number one, why 30 days? Why not 15 days? Why not 45 days? Why not 10 days? Obviously, this question will be there in the mind. So, why 30 days? Because 30 days is the ample time in which some action can be taken. See, what is this for? Firstly, understand, if there is some problem in the bank, all the customers will come running, all of them. For what? Cash withdrawal. Cash. The bank will not have the cash that much. Does any bank have the cash? No. For that, what should they do? They must have HQLA. What is HQLA then? High quality liquid assets. Name itself. Look at this. Liquid assets. What do you mean by liquid? Liquid means immediately sellable. What is immediately sellable? If I am having gold, liquid, immediately sellable. I can sell it right now and get the money. But here we are not talking of gold. Here we are talking of what is easily sellable in bonds. Government bonds. Best ones. Government bonds are one of the best liquid assets. I can sell it anytime. Whenever I want, I'll sell it. Anybody is ready to purchase it. But of course, government should be stable. If I'll sell Pakistan government's bond, nobody will purchase this. If I sell Indian, Bharatiya stable bond, government bonds, anyone will purchase it. So it depends on government also. So HQLA means mainly government securities. I must have that much government security so that tomorrow if something comes for withdrawal, like heavy situation is there for withdrawal, very stress situation, everyone is coming. So I must be able to give cash immediately. See, what will I do? I'll take this HQLA and sell it to some bank. In that case, that bank will give me cash. So that cash I'll use it. Because what happens in case of stress situations, if the customer is not getting the cash, there is more panic. So that's why this 30 days period is there. You must have that much HQLA. You can immediately sell it to any bank and get cash. Okay. And within those 30 days, RBI will take some action. Some bank will purchase somebody so that the depositor is calmed off. Okay. So HQLA to cover net cash outflows over a period of 30 days. Okay. Got it, everyone? The SLR is the minimum percentage of deposits that a commercial has to maintain, a commercial bank has to maintain in form of. Now this question comes in the minds of many students. Many senior bankers also don't know how SLR is kept and how CRR is kept. Many of the senior bankers also don't know. So what is it? See, kindly note, okay, first you answer. Cash reserves with the central bank, liquid cash, gold and other approved securities, long-term loans and advances, fixed assets. Yes? It is? SLR is always kept in form of liquid cash, gold or approved government securities. Then how is CRR kept? CRR is generally kept in cash, CRR. For CRR, what do? There are two methods. Some banks, I'll tell you, this is the old method, traditional method. Some banks actually take the cash. Suppose if my CRR is, let's say, for example, 5%. And I'm having 100 rupees as a cash NDTL today. So I'll take 5 rupees cash, a note of 5 rupees and keep it in the locker. Some specific locker will be assigned for RBI. I'll keep it in that locker. Every day I'll just change and keep it cash. That is old method. New method, open an account for RBI in your branch or bank, whatever, in your bank, and just transfer the money over there, keep it over there. Daily keep on changing, isn't it? As per your NDTL, last day is the NDTL, keep on changing, right? Whatever is the percentage you have to maintain, isn't it? So, SLR is kept in form of liquid cash, gold and other approved securities, whereas CRR is kept in form of generally cash. Okay? Next one. Which of the following would decrease the liquidity in the banking system? Decrease. A decrease in bank rate, a decrease in cash reserve ratio, a decrease in cash, increase in cash reserve ratio, a decrease in SLR. So liquidity, which one will, see, many of you will say that, sir, this is also right. Decrease in bank rate, this is also right. And everything is right. So what should I tick? Because all are important. Bank rate is also important. Cash reserve ratio is also important. The CRR, again, both of same, and SLR is also important. So what will affect me more? Look at the options. Decrease, decrease, decrease. One is only increase, isn't it? So if one is increase, that will be basically this. If I increase the CRR, what will happen? What will happen if I increase the CRR? Think, everyone. What will happen if I increase the CRR? See, what is CRR basically? CRR means the amount of cash or liquidity you have to keep it with the RBI in that account, and you don't get any interest on that. So suppose if I am having 100 rupees and my CRR is now, let's say, 5%. So I'll have to give 5 rupees with RBI. 5 rupees with RBI. Okay. So how much can I give it as a loan then? Loan. How much can I give it as a loan? 95 rupees. So I can earn on 95 rupees by giving the loans. Now if my CRR goes from 5% to 10%, let's say I'm talking hypothetical. So how much will I have to give with RBI? 10 rupees. So how much will I be able to give on loan? 90 rupees. What does this mean? My 5 rupees have reduced. I can't earn on those 5 rupees. I can't earn, isn't it? Simple. So that is the effect of increase in CRR. You get less money to give the loans. So if you have less money to give the loans, it means what? Your liquidity is affected. You don't have money to give loans to the good customers. That is also a problem. Good customers, you don't have money. Isn't it? That is the point. Next. The rate at which Reserve Bank of India borrows money from the banks for the short term is known as borrowed money. See, RBI is borrowing money, borrows. Repo rate, reverse repo rate, bank rate, MSF. Marginal standing facility. What is the rate? Yes, the rate at which RBI borrows. RBI will suck the liquidity from the market for short term. It is. What is repo rate? Repo rate means the rate at which RBI will see repo. RBI and the bank. Okay, banks. Any bank you can call it. Bank. So RBI will give the money, give rupees under repo, and bank will give securities. Securities means government securities generally. Okay. Under repo. Under reverse repo, under reverse repo, yes, RBI again, bank. So bank will give the cash, rupees, and RBI will sell the securities. So RBI borrows, so this is reverse repo. Reverse repo. Again, what is bank rate? Anyone? What is bank rate? What do you mean by bank rate? Let me explain you these two terms, because repo you know, reverse repo you know. What is bank rate and what is MSF? Bank rate means that rate. It's like this personal loan and housing loan. Okay, personal loan and housing loan. Suppose in repo, what does the RBI do? RBI gives money. In bank rate also, RBI gives money to the banks. So RBI will give the money, give rupees to the banks. RBI will give the rupees to the banks. So same as repo, you will say, sir, what is the difference then? Here also rupees giving, here also rupees giving. Look at the difference. This is a home loan. Why? RBI is giving rupees, bank is giving security, mortgage. Right? We give this in home loan. Here what is the bank giving? Nothing. Tan. So here RBI will always just give the money to the bank for urgency, very urgency. Generally it's given overnight. So why is it given? Because the bank faces some crunch. So now logically tell me, bank rate will be higher than repo rate or less than repo rate? Logically, it's like personal loan and home loan. So this is personal loan, this is home loan. So personal loan rate will always be higher than the home loan rate. Same thing over here. Bank rate will always be higher than repo. What is MSF? MSF, marginal standing facility. This is the facility given by RBI. It's a separate window in which the banks can enter into the SLR securities. SLR. Suppose extreme cash crunch is there. This is also gone. Bank needs money. There is no available source. RBI is also not giving this. Or this has been given. Bank rate is given, but exhausted now. Complete exhausted. But still the bank needs money, some urgent problem, something, anything can be the problem. So in this case, RBI has told that you can enter or buy from your SLR securities. Limits given, 2% and 3%. Under normal situation you can buy up to 2%. You can go up to 3% also in extreme situations. So that is known as MSF, okay, where the bank can buy from its SLR securities the cash for a temporary purpose. Okay, got it? So now, let me show you the batches. See this. Go to Adda 24/7. Always purchase through the app. In the app, you will be getting 1% extra. Okay. So that's why purchase through the app first. Okay. Download the app. It's available on this Android also, iPhone also, both of them. So go there. Click on JAIIB and CIB. Look at this. JAIIB and CIB. Okay. Click on CIB December. See this. CIB December. Remember, the prices are changing from tomorrow. Okay. The prices are changing from August 1. Don't miss this. Buy today only. By today 12 p.m. Okay. 12 a.m. Yeah. Buy today by 12 a.m. See this Officers Pro batch. Just now the batch has started. Ebooks, mock tests, online live classes, recorded sessions, everything you are having. Okay. Join this ASAP. You have the AI assistant also. Okay. So, how to buy? Click on buy now. Put the code Y432. Y432. Click on enter. Look at this. 80% discount plus 1% extra. 81%. 81% discount plus this AI assistant. Plus you get this. See this ebooks and mock tests. They are so huge. Mock tests are to the level of chapter wise. Ebooks also chapter wise. Mock tests are full length also, chapter wise also. You can purchase Mahapack also. CIB Mahapack. One of the best Mahapacks. Okay. See this. CIB Increment Mahapack. One of the best Mahapacks. In this Mahapack, you are getting 15 plus batches per subject. 15 plus batches per subject. Plus, right now you are getting double validity. You buy for 6 months, you get it for 12 months. Buy for 12 months, you get it for 24 months. Plus 81% discount. So everything is plus 15 plus batches per subject. So don't miss it.